Good morning, ladies and gentlemen. Well, the model went to risk off on the 25th, and we anticipated that nicely, but I think it's premature. I think it's going to do something like this for the time being, i.e. several days of going sideways and then probably start going up again. But we have time to decide what happens next, and there is no need to anticipate at the moment. I still think that 58.65 is the absolute key for SPX, and let's examine the evidence for that. Last week I told you that this chart is all I'm looking at. I thought over government, and that any close below this 562 was going to be bearish, and on Friday we just managed in the last hour to go back above it, and this is a very clear 200-day moving average which is supporting it. I expect next week to go sideways because the market really skated already to where all the information is, and all we have done is we've increased the probabilities of a growth slowdown over the coming months as a result of Trump's policies. Increasing the probabilities and getting that result are two completely different things. Having increased the probabilities, now we wait for data that will confirm it. I don't think we're going to get that data next week because simply it's too early for NFP to reflect what is going on in the economy, and also it's a backward-looking measure. So January, nothing really happened to employment. Doge had not fired all the federal workers that it will fire or has fired, and therefore it's going to take time for this to turn fully. I don't expect it to go, marching up, but I do expect it to be slightly higher at some stage during the week. You saw the amazing squeeze in the last hour of trading on Friday in SPX, and that is the kind of thing that I was expecting, a squeeze at some time. I am not going to start selling SPX. I would much rather sell calls in equities. I think that is a much safer trade than being short right now. The one that is beginning to break down is SPY TLT, but also it's above the 200-day moving average, so it has room to just go sideways and consolidate. It's at the previous December levels, but also it's above the level where it was in November. I think all we're doing is retesting everywhere. In every chart, we're retesting where we were the day before the election. And therefore, this is a different chart. Don't look at SPY TLT, look at ITOT over government, because that gives you a much better idea. I think that we are going to go sideways in this as well and probably start trading up here during the course of the week. And that is why I keep on saying that I think calls are a much better way to be short of the equity market. So short calls as opposed to short the outrights, because I just don't think that this market is ready to break down yet. It might do, but it needs data now to start breaking down. I'll examine that later on in the equity session. Let's have a look at what the bond market is doing and what the bond market is saying, because I am really not understanding that part. There was an incessant bid all week in the bonds, which is odd given the fact that we had auctions, but it also tells you something. People need duration, and or they're betting that Besant will actually achieve his aim of a lower 10-year note. He keeps on telling us that he is interested in getting a lower 10-year note fine, but the only way he's going to get a lower 10-year note for now is if growth really does slow down, and therefore the stock market probably needs to give up some more. I don't see that we're going to get evidence of that for quite some time, but the market, I guess, is certainly giving it the benefit of the doubt. The 5-year and the 10-year are the areas where the most buying is taking place. It's not so much the 2s, and you can see that something like the 2s, 5s is flattening. The 2s, 10s is also not doing anything. The 10s, 30s is actually steepening, and the 2s, 30s is steepening as well. So all the demand is from 5 years out to 10 years, and if you look at 10s, 30s, that has steepened as well. So people are not buying the 30s, they're buying the 5s and 10s. The 2s are going where they're going simply because there is so much buying in the intermediate part of the curve, and they're being dragged lower. The 2s just don't know if the Fed is going to be able to cut anytime soon. What is obvious now is that every time things get to general collateral, people buy. I'm not so sure that that is so wise, but that is just a function of the probabilities being increased that the Fed is going to cut. We are now at 2 to 3 cuts for 2026, and what the market is basically saying throughout the curve in bonds is that the probabilities have increased that the growth will slow down, that the budget deficit will be cut, and cut probably quite substantially, and that therefore the risk premium need to come down and that real rates need to come down. And let's have a look at those. So here we have the term premium on a 10-year, and it hasn't updated since the 21st. We're now down here, and you can see where the support is. It's around the 40 level. Every time it gets down here, unless there's something really going on, it then bounces again. I would have thought that that is probably an appropriate target for the time being, which gives us probably another 10 basis points of downside in the bonds, in the 10-year notes, probably the 5s as well. If we have a look at actually what the real rates are doing, they have come down quite substantially, and they are probably headed towards the 175 level or slightly lower, which is another 10 basis points there as well. I really don't see them coming down back into the 150s, because if that were to happen, then you will really be saying that the inflation is licked. And I can't see that for the time being. I think this is just an increase in probabilities and that it's more or less done. So having looked at targets in reals and in risk premium, let's try to put that together with the 10-year note. This seems to be a very pivotal level for 12, and that is where I would expect the market to bottom pre-NFP. To me, at 412, doing some put spreads on the 10-year note or the 30-year note really is the trade for now, because what happens if NFP is strong, and why wouldn't it be strong? What happened during the month of January that is going to tell us that we are having some kind of a real growth scare, i.e. confirming the fears of the market? Well, not a lot. I just can't see that through 412 we have any kind of cushion for bad news, i.e. bad news in terms of good news, in terms of growth. So I think now we have a situation in which inflation is absolutely key. And I don't think that the imposition of tariffs, which happens now, this week coming, and after that again in April, is the kind of news that is going to make inflation come down. I think at 412, if you do some put spreads on the 10-year note and the 30-year note, I really can't see that you're going to get absolutely slammed. The risk reward is certainly there, because now, having anticipated all this, having skated to the growth scare, I think the market really needs data to confirm it before it can go further. Europe was dragged by the US lower in yield all week. This is the Schatz, and it's quite obvious that the Schatz is in this range and it's unlikely to break out. 225 down to 191 is your range. I can't see any reason why it should break out. We do have the ECB this week, but anything they might do is fully discounted. Same, really, the fives are probably a better bet to me, but the tens are really telling you the story. Flat 200-day moving average in a range between 257 and let's call it back down to this kind of level, 226. So that gives you potentially 12 basis points more on the downside, but that is all there is. And the differentials actually tell you the story that Europe is not doing anything. And really, when you think about it, the tariffs that are going to be coming in March and in April should reduce growth in Europe, if anything, because Trump is quite adamant that VAT is like a tariff, and therefore reciprocity demands that he puts on 25% tariffs on European products. Well, since Europe is really an exporting bloc, you would have thought that the hit to growth, if anywhere in the world, is going to come onto Europe, and that is not being reflected in what is going on. I think there's a lot of hope going on in the US that really they're going to be able to cut their budget deficit. I am very skeptical that the budget deficit will be lower this year than last year. I think it might go up, but probably slightly less than the worst doomsters think. But I can't see the budget deficit being cut. I can only see it being increased. And if you get a recession in the US, the budget deficit is going to go into double figures, so in terms of percentage to GDP. So I just can't see that Europe at these levels is not a better bet than the US, or at least that if it doesn't go down, then you really do want to start doing some put spreads on 10s and 30s in the US, like I suggested a minute ago. The differentials between the US and Germany confirm what I just said a few minutes ago, that all week the European bonds were being dragged by the US bonds lower in yield. And it's really getting to some pretty ridiculous levels. This is twos. I would be very surprised if we can go below this 193 level. And in tens, we have really broken down, while the dollar is saying something completely different. Where do I think that those absolute ridiculous levels lie? And I think it's here at 173. I think at 173, if you triangulate that with the moves that we had, that I thought we can have in tens, that is about the level where I think that if you see that, the reaction higher should start coming. I just don't see why European bonds should languish while US bonds, go down in yield by leaps and bounds. Just doesn't make any sense to me, given the economic situation. we definitely would need some confirmation from data to start going through this level, while the dollar does the complete opposite. That just makes no sense to me. I completely miss buying the dollar at 106 and a quarter simply because of the differentials, and I could see the differentials coming in, and the dollar going higher and higher. Obviously, it's something to do with tariffs and the expectation of tariffs, and therefore the dollar needs to rise as a result of the tariffs. Yes, probably. I mean, unless things triangulate, I just don't want to trade them. Unless everything is confirming, I just think it's better to leave it alone. What could happen is that the market goes up to either 108 or here to 108.50 and then starts coming back, because the differentials are saying that the market should be quite a bit lower. It's quite possible that external effects like tariff expectations overwhelm differentials, interest rate differentials short term. That happens all the time, and then I just don't trade it. But longer term, differentials are the things that determine the value of currencies. So I'm very, very skeptical that the dollar can maintain these higher levels or even go higher. I would much rather play the same game in Dixie as I want to play in the 10-year note, and that is buy put spreads in the 10-year notes and buy put spreads in the Dixie as well. To me, that is the only thing that really makes sense. But unless things triangulate, and until they triangulate, I don't really want to be involved here. I think the odds of making some serious money here are really not all that good. What is clear, though, is that this 106.25 level is a very important level, and next time we're at it, if it starts breaking down, we know what to do. But I don't think it's going to be next week for sure. What is also becoming increasingly clear is that Euro JPY has actually turned the corner. I don't think it's yet time to break this 154 level, but every time it goes up towards 160, I want to be short of it. And if one looks at the the dollar against the yen itself, I think this 152 level is crucial. You can see the 200-day moving average is turning. You can see how there's a whole series of tops and bottoms at 152, and I think buying some call spreads on the yen and put spreads on on the dollar JPY at 152 makes perfect sense to me. I think we get there. We might even get to 154, but I think Trump wants this to turn. The way it turns has to be through interest rate differentials as well, and that is happening a little bit in the against the yen, where it's not happening against the euro, and therefore to me Euro JPY at some stage has to break down. Last week was basically a deleveraging week, and you had people selling gold as a result. I think it's probably nearly over. 28.40 level was probably quite good, and now we just go a little bit sideways. I still think that gold, while it's above this 27.90 level, is perfectly all right. I'm a better buyer than seller, and simply what it has done is really retraced against TLT from very, very overbought levels. And what makes sense also is that it's retraced against TIP. But you can see that we are now at the previous highs that we had in November, and this is just a recurring theme, isn't it? Everything is back to where it was at the beginning of November before the election. It makes sense to me that it now goes sideways. I still prefer TIP because I get a 2% yield, real yield, and I think inflation remains sticky. But obviously, people prefer gold simply because of the safety. So unless this trend starts turning, and we have a long way to go before this trend changes, then gold is going to remain bid. And certainly it should remain bid, especially against commodities. That's the only thing that really makes sense. So here we have GSG, and it's quite obvious that it's going nowhere. Deleveraging also brought down the commodities. What are commodities saying? Commodities are saying that there is no acceleration of inflation at the moment, and they're in this 2070 to 2300 range, which is, well, 10%. Up, down, oil goes up, we go up, oil comes down, we go down. There is no inherent price pressure anywhere in the commodity sector. And if one has a look at the differentials, and here this is a chart of GLD over GSG, you can actually see that it didn't do anything at all last week, and it's still in a very strong uptrend. Gold is going up against commodities, so it's not a problem of gold, it's a problem of commodities. And therefore, every time it dips, and I would have thought any kind of dip here, that is going to give you the signal that it's time to buy gold. I'm not looking at gold per se at a level. I'm more looking at its price against commodities, because if commodities are stable within a range and gold is going up, you want to be buying gold when it's on a support level against commodities. That gives you the best risk reward. Now, if you go back several weeks, you'll remember that I told you to look at the butterfly between gold, SPY, and TLT. And this is what we've had, and we've gone back to the 200 moving average. That also tells me that this move is nearly exhausted. I mean, we could have a few more bounces and go slightly above, like here, but it's really going nowhere. And what that tells me is that equities are probably exhausted to the downside as well. Why do I think that? Again, we are just skating to where the probabilities are, and we are having increased probabilities of a growth slowdown. We're not having a growth slowdown, we're just having increased probabilities. And therefore it makes sense that the market buys gold and TLT over SPY for a period. And that is the period. We've increased the probabilities. To go further, we need data, and we are just not going to get it anytime soon. We're just not going to get those confirmations. When can we get them? Well, we can get them sometime late spring, early summer, but I just don't think that we get them before then. Let's start with a clean SPX chart, enlarge it, and really it did everything completely right. 58, 64, 5, whatever, bounced straight up. We couldn't go underneath it. It's doing exactly what it did here, or exactly what it did here. You can see how strong this support line is, and the one underneath, especially 57.62. What do I expect this next week? I expect us to trade up to 6,000 and no more before going back down to 58.64 again. I don't know in which sequence, and it really doesn't matter. What I'm trying to say to you is that what is the point of trying to get too short too soon? I think that this is a trading market now. I think that the risk reward at 58.64 is to be flat, and every time it bounces up to these kinds of levels, the risk reward is to have some put spreads, some very short-term put spreads, that if the market goes down 30-40 points, you make some money and you get out again. The very idea that we can break down hard right now without data, having skated to an increase of probabilities of a growth slowdown, I think is low odds. I think that you want to be short of calls, yes, but do you really want to be short at 58.64? I don't think so. We closed the month, and here's the monthly candle, and it's slightly red, but you really got to squint to see the redness there. It basically did absolutely nothing all month. It opened 59.68 and it closed 59.57. Okay, how exciting. So that actually makes sense, right? Why should we be powering ahead, and why should we be going down hard unless we know what the data tells us? And the data is not going to tell us anything for a bit. And that's why I think that selling calls is a much better option than selling the market outright. If we have a look at what happened on the dailies on Friday, well, basically, it just came back within the Bollinger Bands, and we are beginning to slowly turn these moving averages. This one here, these here at 59.90 to 6,000, to me are going to be important in the SPX. And if you have a look at what's happening on the weeklies, we're still going down, we're still deleveraging, we're doing it at a slow pace. And this is the chart that basically says it all. This is the 200 period moving average, and we just went back to it on the close of Friday because we just couldn't break below 58.65. And that to me says that we go up to 6,000, come back down, up to 60.45, come back down. We are in a period of stability. Probably, could we be doing a head and shoulders here? Possibly, but we probably need at least 3 weeks of going up and down here to do the right shoulder. So you understand what I'm saying? We need data to start breaking down hard. Exactly the same thing for the NDX. Support 20,661, couldn't stay below it, straight back up. 200 period moving average on the 195 minutes chart, which divides the day in two, still going up. Where do we think the probabilities are that we have highs during the week? 21,300, 21,400. Those are the probabilities where the highs are, and that should equate to around the 6,000 level in SPX. End of story. That's where we are. We're not going down hard, we're just going sideways. Could we be doing again a head and shoulders of some sort? Possibly, but it's going to take time in everything. Therefore, I'm just not a huge seller until I see a decent level. And also, none of the foreign markets are showing any sign that they're ready to completely break down. Europe is going to take a long time consolidating because it closed right at the monthly Bollinger Band. The next monthly Bollinger Band will be probably somewhere not very far above 5,500, and I'll tell you what that will be next week. But I think that we are in a range, and we are really going to be supported below 5,300. So this kind of level, 5280 to 5,300, I think is all that's likely to happen to European bonds, European equities. And if you think about it, if that is all that happens to European equities, when the threat of tariffs is upon them, as opposed to the US, and the fact that the price of their goods is going to go up, and therefore the demand for their goods should go down, you would have thought that the problem would be here, and therefore if this market is supported, I really don't see any reason why the US market should fall apart. I'm a firm believer that VIX is going to tell us when we're about to fall apart, and I don't think that we're there yet. I think the probabilities are higher that we go back towards 18 than we are that we break 2060 on a weekly basis and go up to 2279, 2280. Anything in the above 2060 on a weekly basis is actually going to tell me that we are starting to break down. I don't see any evidence of it. I think that we are more likely to come down in volatility than go up, and therefore that tells me that we are range trading for a while. So what am I going to look for next week? I'm going to look for the 10-year note at 414. I think that is a very good level to start doing some put spreads. And I'm also going to be looking for a move up to 6002 in SPX to sell calls or during that move up there. I think the odds of breaking 58.64 next week are very low, certainly before NFP. I don't think NFP is going to tell us anything useful about what is going to happen. It's just going to tell us what happened in January, and I think the market is completely going to disregard it. NDX, if you want to trade that, those are your levels to the upside, and 20,660 on a weekly basis, a close below, I think gives us at least 19,900, but I don't expect that to happen. Thank you very much indeed, and tweet you tomorrow.